Hello guys, welcome back to my channel. Time and money to have the best experiences out of your life. So in this video we are going to see why the stock markets are going bonkers and why stock market is so much volatile and how you can take action so that you can profit from this uncertainty. So without any ado, let's delve right into it. So first of all, the rising inflation across the world, not just in India but US and various other major markets, is what is driving the sentiments negative. And because of this increasing expectation of inflation and the same thing to continue in future, people are moving their investments from these slightly riskier investment options of stocks to much more safer options of bonds or government debts. And this is being done by institutional investors as well, because of which stock markets is going down for the short term. And the reason why inflation is growing at such high pace is because in 2020 all major governments printed lot of money just because to ease down the situation that was happening at that time. And because of printing such high amount of money, market is flooded with liquid cash, and because of that more money is chasing those few goods, and because of which the prices are increasing. Again, this is a very easier version of explaining inflation. And because of that the prices are rising. And another is chip shortage that is being caused. All electronic goods are being affected by that, and because of this the whole supply chain and various other inputs that need to be involved in the end-to-end supply of any goods is being affected by these rise. And also because of rising crude oil, this is impacting various other things and driving up the prices in the entire supply chain. And second point is geopolitical tension that is happening, and because of that stock markets do not like uncertainty, and especially something like this, a global factor which might impact many of the economies, might be driving down the prices. You might think why something that is happening in Russia and Ukraine is bothering us here in India. Because we are a global economy, it acts like a dominoes effect. That is, one domino toppling brings down many other dominoes down, and because of that interrelated dependency on each other's economy is one of the reason. Second reason is because Ukraine and Russia are one of the largest exporters of silicon that is used for chip building. And again there is expectation that these electronic goods can become much more costlier, again driving up inflation. These two are the main reasons because of which stock market is so much volatile. And again, as I said earlier as well, and as many experts believe, stock markets are not rational. It is completely irrational game, and because of that these stocks can fluctuate a lot just because of market sentiments, and there is no clear explanation to it. Again, there are various theories explaining it which I would like to cover. So now, given that you know that stock markets are so much volatile, what should you do so that you safeguard your investment and your investment grows? The easiest answer is buy and hold. That is, in each dip that you get, keep investing in it. That too, especially keep investing in these dips. That too, especially for a time horizon of 5 to 10 years plus, wherein there is a good certainty that in such long term it will perform and generate you a decent amount of return, if not great returns. But let's delve a little deeper to get a little more broader understanding. Few studies suggest that just incorporating 1 to 2% of cryptocurrencies into your portfolio, again in these 1 to 2% you can rely on the established names like Bitcoin, Ethereum, and invest in them. And diversifying others in good performing economies and good performing stocks will yield you good returns in the long run. And for most of us, around 80 to 90% of people, it's just good strategy to keep on investing at a regular interval, so that it will give you something called dollar cost averaging or rupee cost averaging. But if you think you have some insights into the market and where you can buy on the dip, then you can keep some amount of cash aside and invest them during those dips, especially like the current scenario wherein in one day stock markets had crashed by 3 to 5% on an average, and few stocks had bleeded much more worse, and just the next day it had recouped all those losses just within one trading session. In such scenarios you can decide how you can play it, but it's always best to invest at least some amount of money regularly irrespective of what happens. And maybe the extra money that you have, you can consider investing during such dips, and you can consider it like a top up of your portfolio, so that in long run it can help you to generate slightly higher return which can outperform the market and help you generate a good return. So that it is best strategy to continue investing in this and average out, so that in long term you will have great returns. Again, if you have doubts on how to invest, how to budget, do subscribe to my channel and watch various videos that I have done. Again, a quick thumb rule that you can use is 50-30-20 rule, and you should invest at least 20% of your income for your long term investing, along with 3 to 6 months of emergency expenses, plus along with that some safe avenues for investing and others for long term investing, so that you can generate lot higher return, especially for time horizons of 5 to 10 years, and which can help you to achieve various realistic financial goals and lead a happier and better life, so that you can experience the life the way you desired it. So with that, ensure to like, comment down below, as well as subscribe down to my channel and turn on all the notification, and also ensure to join my Telegram channel, where I want to build a good bunch of community and hope to see you there.